Hello, I'm Jenny Brown and a very warm welcome to our buy-to-let mortgage market update. Hope everyone's keeping well and warm. I am freezing cold today. It's really chilly in my office. I'm actually nursing a cup of coffee while I'm talking to you, just trying to keep my hands warm than anything else. It's not boding well for the winter, is it? Okay, so what have we seen from lenders over the last week? So first of all, Landbay have released two new limited edition products, one at 60% loan to value, one at 70% loan to value. They're not bad. Good in the specialist end of the market, I would say, not so much the high street end, but great to see lenders releasing these limited edition products, which we're certainly seeing more at the specialist end of the market at the moment. And the great thing with these limited edition products is they tend to be more competitive than the main product set the lenders have on offer, which means that there are some really great deals popping up here and there for our more specialist landlords to access. That's really good. Now, in terms of Landbay and what they do, so Landbay are a lender who is very happy lending to individuals and limited companies. They don't mind how many properties you've got in the background, a really nice piece of lending criteria. And the other thing that I like about them is the maximum age at application is 79 years old. Now, they do have a minimum income requirement of £25,000 a year, so they're not going to work for absolutely everybody. But they do day one remortgages, which we see quite a lot of demand for at the moment. So that's really positive news that they've released some competitive products. Now, also in the last week, we've seen TSB reprice slightly. So they've removed some 2-year fixed rates and added some 5-year deals to their product set. Now, TSB are definitely more on the vanilla end of the market in terms of appetite for risks. They don't lend on HMOs, multi-units, they're not lending to limited companies. What they will do is accept applications from people looking to borrow in their personal names. Their limitation on background portfolio is 11 mortgaged properties. And applicants do need to be earning £25,000 or above. Now, their maximum age at application is 70, so it is a fairly standard bit of lending policy that they have there, so nothing too racy. But what I would say is the pricing therefore is reflective of this, and so the rates are very good. Now, we've also seen this week Lendingvest remove their minimum income requirement for limited company applications, for applications up to 75% loan to value. Now, they do actually have products available to 80% loan to value, and to access these, so if you're borrowing over 75 but no more than 80%, their minimum income requirement is £40,000 per year. Now, in terms of where this puts them in the market, Lendingvest are, again, more of a specialist lender. They're good for limited companies, large portfolios in the background, HMOs and multi-units. So by removing this minimum income requirement, I think really what they've done is align themselves with people like the natural competitors. So, for example, Kent Reliance, Precise Mortgages, Keystone Property Finance, those kinds of guys. But good to see some lenders tinkering around with lending policy and pricing to keep the market moving along and keeping things competitive. Some mortgage market data now. So mortgage approvals have reached a 13-year high in August as buyers are taking advantage of the stamp duty cut and low interest rates. And that's according to new data from the Bank of England. Mortgage approvals rose from 66,300 in July to 84,700 in August, the largest increase since October 2007, and exceeding forecasts which were pitched at 71,000. Now, the gross borrowing amounted to 18 billion last month, the highest in a single month. This is sourced from information from the Telegraph. The data also reveals that households paid down around £17 billion of credit card debt during lockdown, while consumer borrowing rose by 300 million in August from July, down from 1.1 billion the previous month and below pre-pandemic levels. And this is really, I guess, just coming back to information that we've talked about before, that because people's spending patterns have changed during lockdown, those people who are fortunate and still employed and weren't on furlough on lower incomes were in a position where they were spending less money, therefore reducing their borrowing in the background, which is really positive. And I think actually I read somewhere recently that actually the amount of money that's in savings accounts has also increased over lockdown. So people are putting themselves in sort of more secure positions financially because of this. The mortgage approvals reaching a new high. I mean, good news for the mortgage market, good news for buyers because it means that more mortgages are being approved. Obviously, it's quite natural to see this happen as we're seeing the housing market really gain momentum and house purchase transactions really pick up. piece of news that I saw in the last few days which caught my eye that I just wanted to share with you, and this resonates with me particularly, and I'll explain why in a minute. The government has committed to upgrading as many private rented sector homes as possible to EPC Band C by 2030. Now, this is a consultation. So this is not actually enforceable in law yet by any stretch of the imagination. But the EPC bandings have caused me personally no end of headache. I have 2 buy-to-let properties. One of them is only 14-ish years old and is a D, and I have also a sort of very period flat in a building, which was an F, and I managed to scrape it up to a band E just to get it lettable. But I can't quite see how I'm going to manage to get it up to a C, so I'm going to have to be applying for exemptions. Now, this is a consultation, so this isn't set in stone by any means, but more news on this to follow as and when we hear it. But just to really give you the heads up that this is kind of looming over us now for the next few years. House price news hot off the press for you this morning. The Halifax house price index has just been released, and it has reported that house prices in September were 7.3% higher than in the same month a year earlier, which is the strongest growth since June 2016. They've gone on to report that on a monthly basis, house prices in September were 1.6% higher than in August, and in the latest quarter, house prices were 3.3% higher than in preceding 3 months. Also, we've seen this week the nationwide house price index be released as well, and they've gone on to report very similar figures. One thing that caught my eye that I just found quite interesting is they're reporting on some regional information. They're saying that the Southwest was the strongest performing region, with annual house price growth rising from 2.3% to 5.5%. For the first time since 2017, house price growth in southern England exceeded that in northern England. Annual house price growth in London continued to edge higher, with prices up 4.4% in quarter 3. They go on to say that average prices in the capital hit a record high of £480,857 and are now 57% above their 2007 levels, which is compared to 21% for the UK as a whole. So really just, more news on house prices going up. The market's still kind of performing really well. When I was reading through the Halifax House Price Index reporting, there was an element of caution also added in, with them saying that essentially they're not expecting the house price growth to continue on this vein indefinitely, and they are expecting to see a softening in the market later into the autumn or in spring of 2021. Moving away from house prices and moving on to rental yields, which as landlords is obviously a subject quite close to our hearts. So some information has been reported that the average rent in the UK is now £987, which is up 0.2% on last month and 2.1% higher year on year. And this is according to the September Home Let Rental Index. Now, what they say is that when you exclude London, this average rental figure per month drops to £828, and this is up 0.4% compared to last month and 3.9% year on year. So what this is really telling us is that if you take London out of the mix, while the average rent per property comes down, actually the growth is much stronger, excluding London. Now, what they did say is that average rental values in London, which are £1,646 per month, was still 9.8% higher than when considering the rest of the UK, excluding London. So again, really just backing up what we're seeing, the reporting of rental prices continuing to increase. They're not setting the world like they're not going crazy, but they are holding firm and increasing fairly steadily. Another article which I read this week, which I thought was quite interesting, is about stamp duty. Now, what this article essentially started off by saying is that 14% of homeowners have been forced to take out short-term loans or emergency credit to cover the cost of unexpected stamp duty payments. This is the equivalent of 1.92 million people, which is really quite a lot of people who weren't prepared to pay their stamp duty. I just found that quite surprising more than anything else. But the next part of the article, which is the bit which I think was quite interesting, So what they've gone on to say is that in more normal times, research from Cornerstone Tax reveals that stamp duty is a poorly understood tax. Research shows that 15 million home buyers have never even considered whether there was a mistake in the stamp duty which they paid. This is despite the fact that Cornerstone estimates that mistakes in advice mean that around 120,000 people in the UK are owed refunds for just one of the many issues with stamp duty advice. In 2017 and 2018, over £12.9 billion in stamp duty was paid by homeowners in the UK, while in 2016 and 17 alone, over 6,800 additional property refunds totalling £80 million were paid, which is just one small section of the market, and this is due to errors in advice. So, I'm not suggesting that we all start, phoning up the revenue and start claiming that we've overpaid our stamp duty, but it is just kind of worth knowing that there is clearly a contingent of people who have overpaid on stamp duty in transactions, and to really just do your own due diligence if you are buying property, just to make sure that you are paying the correct amount. Now, this week, I'm just going to finish up talking to you about limited company borrowing and try and cover off the rest of the kind of key points that I think you need to know when you're considering using a limited company for your investments. So last week we covered off what is an SPV versus trading company. We looked at SITCos, we looked at setting up the company, we talked about personal guarantees and various shareholding structures and the implications of these. Today I want to just talk to you briefly about the kind of practicalities of applying for a mortgage through a limited company. Now, one of the questions we get asked often is, how easy is it to apply for a mortgage through a limited company? And of course, I'm going to say it's really easy, but it actually really is quite straightforward. So when you apply for a mortgage through a limited company, you will see that the questions you ask about the company will be, what's the company name? What's the company number? Where's the registered address? Who's your accountant? And then the remaining questions you're going to be asked are all about the directors and shareholders, the people who are going to be essentially giving the personal guarantees, which we talked about last week. And the information that you're going to need to provide in terms of documentation is largely centred around the applicants, as you would experience if you're applying for a mortgage in your personal name. The only time you'll really have to provide paperwork for the actual limited company itself is if the company has trading history behind it and you have accounts and bank statements. But if you set up a brand new company, yesterday, you're not going to be able to provide much in the way of paperwork for the lender, so you're not going to need to supply anything. So the actual process of applying for a mortgage through a limited company is, in terms of the steps that you go through, there's an agreement in principle, the mortgage is underwritten in the same way, there's still a valuation, there's a mortgage offer. The actual sense of applying for the mortgage is virtually identical to when you apply for the mortgage in your personal names. So it is honestly really quite straightforward. So don't let that kind of worry put you off doing it. Now, one of the things that we get asked a lot as well is in terms of how the lending criteria differs for limited company borrowing to that if you're borrowing personally. And I think my view on this actually is lending criteria is more generous if you're buying through a limited company, insofar as the kinds of lenders who are in the limited company space are the more specialist lenders who are, generally speaking, and you'll see from when I'm doing this whole kind of lender update at the beginning, the specialist lenders are the ones who don't mind how many buy-to-lets you've got in the background, don't tend to have minimum income requirements, are happy with HMOs, happy with multi-units. These are the guys who are really, fully into the landlord community and that landlord space. So you'll find that actually, my opinion is that it's there's a more appetite to lend to kind of real landlord transactions if you're going through a limited company, because by the nature of the fact we're using a limited company, you're going to that kind of a lender. Now, in terms of the actual kind of process of buying a property through a limited company, one of the things that I think is often confusing for people is deposits. So often we are asked, does my company have to have money in it? What if I'm selling a property from my own name to my limited company? How does that work? And how do I actually put money into a limited company? So essentially what would happen is if you were buying, I don't know, your first buy-to-let property through a limited company, you're going to need to put cash into that business as a deposit in the same way as if you were buying the property in your own name, you'd need to have cash available. The way that you would move that money into the company is via what's called a director's loan. And this is something your accountant can help you with and advise you how to do it, so it's kind of documented appropriately. But the benefit of doing a director's loan is that you will essentially lend the money to your business. Generally speaking, we don't see our clients charging the company interest for this loan. But what will happen is then in time, in the future, when the company has money in it, surplus funds, it's able to start repaying you the money that it owes to you. And repayment of director's loan is non-taxable, so you can start to bring your money back out of the business and you wouldn't pay tax on this. Now, another scenario we see is where people have a property in their own names that they're looking to move across to a limited company. And this is where it gets a little bit confusing because there's actually no physical money, cash as it were, knocking around for these types of transactions. So what would happen here is if you were selling the property to the company for £200,000 and you had a mortgage in your personal name currently of £100,000, and that's all you wanted to kind of see out of the deal is £100,000 paid back to you. So your company would buy the property for £200,000 and raise a mortgage for £100,000, which would then come back and pay you off. The remaining £100,000 of equity would essentially be lent via you to the company as a director's loan again. So it's a paper exercise. It's quite a complicated thing. Well, it's not complicated at all, actually, but it feels complicated and people struggle to get their heads around it. But I can assure you it's perfectly doable and fine and legal. So yeah, again, this is something your accountant will be able to advise you on once you come to do this kind of thing. Now, the other 2 points I just wanted to touch on briefly with limited company borrowing, which are where things are potentially slightly different to what you may have experienced buying personally, are first of all solicitors. So when you're buying a property through your limited company, generally speaking, you will find that the lenders will have a panel of solicitors who they see as acceptable, an acceptable firm to do the legal conveyancing for them. And this applies to all mortgages, so every lender has an acceptable panel of solicitors. And the reason they will want to agree that the firm of solicitors that has been used is acceptable is because not only are they acting for you, the borrower, but they're also acting for the lenders. These guys, the lenders, want to make sure that the firm you're using are doing things correctly. Now, in the limited company space, you'll find that lenders tend to have a much more restricted panel of solicitors. So what I would say to you is if you are looking to do a transaction through a limited company, it's probably best to figure out who your mortgage is going to be with first and then find a solicitor who is on panel, rather than starting off with a solicitor, parting with money, paying for searches and that kind of stuff, and then finding that they're not on panel and then trying to source a lender to fit around your solicitor, which is a bit like the tail wagging the dog, I think. The other thing that you will come across is that some lenders, in fact most lenders, will need you, the people behind the limited company, to obtain independent legal advice. And this is in relation to the fact that you are going to be offering personal guarantees. So when I did my limited company purchase, I had to go and sit with a solicitor and they ran through the document which sets out my personal guarantee and my obligations. And then I had to sign to confirm that I was comfortable with what that actually meant for me and what I was kind of in for. And the reason lenders want this to happen is that if you do not obtain independent legal advice and simply sign a personal guarantee, in time in the future, you could potentially say that actually you didn't understand what you were signing. You just, you signed it because your husband or wife gave you the bit of paper and you didn't really know what it meant for you. And therefore, it can leave the lender's security, as it were, vulnerable. So that's why lenders may ask for this. If you do have to get ILA, there is a cost for doing so. So again, if it is something that you are kind of wanting to factoring into your pricing, you just would want to ask us, the mortgage broker, whether the lender that's been recommended does insist on ILA, so you know where this is going to land in terms of costs. So that's kind of all I've really wanted to cover off on the limited company piece for you, which I hope you found helpful over the last couple of weeks. Next week, we're going to be looking at refurb and refurb mortgages, refurb projects and how we can finance those. And then the week after, we're going to be moving on to holiday lets. I know quite a few people have contacted us asking for us to cover that off, which we're going to be doing in a couple of weeks' time. So thanks for bearing with us. But for now, I hope today's video has been helpful. I know it's been quite long, so thank you for bearing with us. As always, if you'd like to have a chat, do give us a call, 0345 345 6788, or do go and have a look at our website, mortgagesforbusiness.co.uk, where there is oodles of information for you to have a look at, which people really seem to find very helpful. That's it for me. Look after yourselves, and I will see you next week.